Welcome to Beyond the Bottom Line, the podcast where founders and business owners get in-depth insights and actionable takeaways from industry experts. We're here to help maximize your revenue, streamline your operations, and keep more of your hard-earned money. Now here's your host, Miguel Alexander Centeno.
Thank you for joining this conversation. I am Miguel, founder and CEO of Centurion Firm, where I have the honor of leading a small tax strategy team serving businesses just like yours. And the cool thing about what I do is I get to work with businesses who are doing much cooler things. I do a deep dive with clients, mentors, and businesses I admire about their world, how they think about their topic, and how you as a business owner or operator can learn from the best. Let's dive into this episode with Michael Dombrowski, head of treasury at Rho. We're going to get into the core of the topic, which is how we use treasury, how Rho helps its customers get some ROI on its cash and spend. We'll weave in some tax, of course, as a tax firm. Mike, I think you have an amazing background. Tell me a little bit about what is treasury? What are we talking about here?
Treasury, just in general, is your strategy and how you're going to build out how you're going to manage your company's cash. So we're talking from everything from, hey, we're going to open up our first bank account, to we need to have multiple bank accounts because we have international entities, to how you're going to put that idle cash to work in investing, which is going to be one of our main topics today. And to make sure that every dollar, and all this is about making sure every dollar that you raise or you're earning from your earning of revenue is being put in the best place to make your business continue to grow. So a lot of people don't go through that strategy session and put these things into place. So it is a missed opportunity in my opinion.
Yeah. And I think, we want to think strategically and we want to think like, is this for me? We talked a little bit yesterday. A lot of our clients think treasury is something that only the Fortune 500 do. How do you think about, every business owner having access to this and why is it important?
That is a great question because historically, you're 100% correct. Historically, treasury strategy, investing idle company cash, that was reserved for the mega Fortune 500 companies. Why? That's because they had to have a full finance team. They had to have a full built-out CFO function and all those individuals below that top team person. They may even be doing trading themselves, or maybe they're linking up with a Wall Street firm. But now, thanks to technology and the way technology opens up the ability to have access to these things has now grown. And the Rho platform is very similar and a great example of that, to where now technology is allowing for companies of all sizes to actually start implementing Fortune 500 strategies at any stage of their business. So again, from day one till beyond that. So technology is really the lever here.
And what kind of dollars are we thinking? I know we get into case studies a little more, but let's quantify this a bit.
Yeah, that's an interesting question because a lot of times you have to think about, everybody can start out as a business owner in their garage and they think, I just need to go and start doing this and I don't need to think about something like treasury and strategy. I personally believe that is incorrect. So even at that stage, the purpose of doing that and instituting these strategies is because you're going to grow into the future. So the idea for the smaller dollars or the smaller type of companies, you need to be thinking about this as an infrastructure play. You're starting to set your business up for success in the future as you continue to grow. Now, as your company becomes more mature, a lot of these components become more valuable. As the dollars increase that your company has, it's a greater and greater opportunity for you to earn actually on that capital, which then turns around and can be put right back into your business for a myriad of reasons, hiring, specific projects, et cetera, et cetera. So it really starts out at the very beginning of the game, the garage, and it goes up until, you even go to IPO. So there is no specific money number. It's about starting early and often and building out the infrastructure and following the strategies.
Oh, I love that because I think even with tax strategy, you have something similar where the juice might not be big enough to squeeze just yet, but there's something to building a practice of exercising that strategy, that knowing how to deal with that. You're not starting from square one when you're actually, like for example, you raise $2 million. We see this all the time. They raise $2 million. It's a conservative founder. And because of capital markets, that's a 2-year run rate. If you're at that point and you've passed a month already of that just sitting at a 0%, you've already lost money. But yeah, to your point, I love the idea of building the practice early so that you're ready when it's actually got a big ROI. Do you agree with that?
100% agree with that. I always like to say, kind of like muscle memory, right? It's like going to the gym. You got to go in, you got to put in the reps. Or if you're a sports player, I never like to really go down sports analogies because they're super played out. But it is about muscle memory. It's about putting in the right processes and getting things going at the early stage so you're not having to play catch up. Start early on, continue to put those reps in, and as things continue to grow, you're already set up for the future. Is really what it's boiling down to on the early stages.
And I fully agree. I think it also applies with other concepts and, whether it's finance or tax, it's getting that muscle memory is going to allow you to really use it when you need it. So if I'm a founder, I've got a fiduciary duty to protect this cash. I know when we dealt with it, we didn't want to park it all in the S&P just because if the market's down 10% for whatever reason, that's 10% less cash that I now can't use to pay payroll. So for those who are like treasury, man, I can't bet the company money. How do you think about
that? Way to think about it, and everybody needs to understand, right? Corporate cash in your business, you're not a hedge fund. You're starting your business for a specific reason and a specific mission. So you're not a hedge fund. So you shouldn't be considering going YOLO with Bitcoin or putting some of your funds into the S&P 500. That is not what the purpose of your funds or what you would call your beginning treasury or your treasury as a company is what you should be doing. There are a laundry lists of very conservative, low risk investment options and vehicles that you can put your company cash into, which we'll talk about a little bit later, that are very low risk, very liquid, and they fit and hit all the specific points that you should be thinking about with that cash. So what I think the barrier to entry is to many people is exactly what you're saying. They're like, it's my money. I don't want to lose it. I need to be ultra safe and just leave it there. But that's actually hurting them, as you're highlighting, and we'll highlight later. There's inflation. They can be making money on top of it, interest on that. So they're actually leaving a lot of benefit on the table by being too conservative because they may not be educated, and all they need to have is some education and see the simple structures of how they could start going and building out that strategy and that treasury strategy for their company from now into the future.
I think it's a great point, and just something to kind of harp on that I think I want to make sure everyone did hear is, CPI in June was like 3%, right? So purchasing power is going down 3%, at least. And this is qualified opinion, so if you're not getting 3%, you don't have a defense mechanism against inflation. So at very least, I think the point to say is treasury is actually a conservative strategy. It's not an aggressive strategy at all.
It's one way I would say it's almost like insurance. You're not simply out there writing a check every month like your car insurance or your home insurance or even your health insurance, but you're actually using that dollar, setting it in a specific vehicle or strategy that is building up that buffer to actually help and protect your future earning potential from the inflation. So I think of it more of like an insurance policy, an actively managed insurance policy to some degree versus, going YOLO and thinking you're going to lose it all, because that's not going to happen, generally speaking.
There you go. Insurance doesn't hurt. Well, let's talk a little bit about how to actually get started. So if I'm listening to this, I'm like, yeah, I got it. But I don't want to take a cold call with a financial, nothing against financial advisors, right? But how does Rho help? How does Rho save that founder?
Yeah, that's a great question, actually. Rho, we are a financial platform. We offer every product that a business would need. One of them specifically is Rho Treasury. And the best thing about Rho Treasury is what it's helping the founder or the company solve for. And I always like to say, you got to think about what you're solving for. And it's making sure the cash is as safe as possible, making sure it's as liquid as that or any company needs, because it's always going to be different. Number 3, making sure it's earning conservative rates of return without unnecessary risk. And then because Rho is a platform trying to make, finance frictionless for all the businesses that use us, our product actually also has some automation built into it. So the team of one, or the garage founder of one, or the CFO and the team of 15, they get the benefit of having things done for them on an automated level. However, they could also get in there and pick and choose and tune and tweak how they want to do things. So our platform is meeting the founders and meeting the teams from baseline 1 up to the top, always thinking about helping people achieve those main goals when it comes to treasury strategy.
I think that's really helpful high level. Let's talk a little bit about the specifics. So where is my cash being invested? What are you guys doing with this?
As we were talking about before, there are multiple different investment vehicles. Typically, you'll see someone going into something for an FDIC protection. For every dollar, they always want to have that. We've got a product for that. That's called Rho Savings. When you get to the Rho Treasury product, we're giving you access and we're giving you tools to hit all of those goals. So meaning, you want your cash to be as safe as possible. Where do you put that? First, number one is usually a U.S. Treasury bill backed by the U.S. government. That makes it de facto one of the safest assets in the world. If you have a slightly higher risk tolerance, you may want to start looking to incorporate other investment assets. There's going to be people out there that love bank CDs or certificate of deposits. Maybe they want to start sprinkling in some other types of assets. Well, in that case, for those type of investors, we offer institutional mutual funds so they can get instant diversification. One click, one button hit. They make that purchase of that asset and they get it spread across multiple different assets. So that's on the options side, right? Like we got to give people conservative options so they can earn reasonable rates of return, but always making sure that the liquidity is there. For us, we're always targeting 2 business days or less. We're working on something right now that should get us same day settlement, which will be huge for people. Also, these assets again could be 2-day liquid, so that we're making sure all of our offerings are hitting the goals that they should be trying to target.
In terms of like where my money is, like, is it in a brokerage? How does that work?
Yeah, that's a good question. We do have to partner up with a custodial service. Our custodial partner is Apex. So what that means is when you're working with the Rho Treasury platform, you are opening up a corporate brokerage account. So there is a wall between Rho and RBB Treasury and the actual client account. But what that means is the client owns all those assets. So no matter what, if Rho disappears or if you want to move on, you don't have to do anything with those assets theoretically. You own those assets in your company's name. They're always sitting in the custodial account over there. And the nice thing is when you have that on the Rho platform, it's all built in. So you got the single sign-on, able to see all of your accounts, checking, savings, treasury, et cetera, et cetera. So it's all built right into that platform. So it's single sign-on and it's incredibly simple and easy. So that's the purpose of Apex. We got to have good partners. You got to make sure the cash is safe and you got to make sure it's sitting where it needs to be at all times.
It really is. I think the other case that we were discussing, I'm a startup. I've raised money. I need cash in my operational account. Maybe I've got an upcoming acquisition. Maybe I've got too much in treasury. And I think you have some stories around that. So can you kind of explore that case study a little bit?
Yeah, it'll probably go into like one of the features of the product, which is kind of interesting. There's always a gentle juggling or tap dancing around the line between I need to have the amount of money I need to have for my business versus how do I maximize or optimize for APY or yield or the investing, right? So there's always a push and a pull between do I want to focus on one versus the other? Unfortunately, a lot of people, once they start getting into treasury or they may be more sophisticated in their mind, they may focus on the optimization of the APY first, which means they may not keep enough cash or readily available operating cash in their operating.
To run payroll. Yeah.
For payrolls as a great example. So how we solve for this, right? Traditionally, either the single founder, CEO, they would need to be monitoring their bank account every day, all day, checking all the transactions. Or if you're a more mature company, you've got your first finance hire, maybe it's someone like Tax Hack, or maybe it's a fractional CFO. They're doing that job. Well, what we've decided to do, and we've made it more of a feature, is we create something called a reverse sweep, to where the client can always keep a specific amount of money in their operating account or their concentration account. And anytime it goes below that level, money actually moves for them. So the knock-on effect is, one, they don't have to keep checking their transactions. Follow-on number 2 is the actual team doing that work. If there is a team, that's off their plate from that point forward. And I like to think about it kind of like driving a car. You're going out on a trip. You always want to have at least 3/4 of a tank or a quarter tank of gas in your car as you're driving. And you get to that quarter tank mark. Typically, you would have to have an action, pull over, go fill up the car. Well, with the reverse sweep, and it's like your operating account, same thing. Once it hits that quarter tank level, the system does all the work for you. It initiates the transaction, so there's no trading for you or your team. The money moves automatically, and it can save you from having, especially when you're a earlier founder, that potential embarrassment of not being able to pay your employees. Which, as we don't need to get into that whole scenario, how bad that can be. But the technology, and the point of it is the technology is actually saving the founder and saving the company of that management, of that movement, and allows them to focus on the most important thing, building their business and their mission that they're actually trying to accomplish.
No, that's very, I think one point I'll pull out of there is that, for those thinking like, oh, I'm just going to buy some T-bills, forget about it. You have to actively manage that, without automation, right? Like you've got to go into wherever you bought those T-bills, sell them. Hopefully it's not a bad day in the market. And then, if there's delays in getting that like it's like you've got an active duty now in treasury. And I love the reverse sweep automation because it removes that step based on that gas tank level you're describing. One question, Mike, if I'm setting this up, am I setting that level? Is that level recommended? How does that work?
Yeah, it's an interesting question there. Most founders and teams, they'll have an idea, and I know we'll talk about certain thresholds and things like that in which you should be thinking. It can be completely self-serve, for sure. You can completely self-serve that on your own. If you are working with Rho Treasury, you do have access to a treasury advisor to kind of get some nudges or help you with some of that, a little bit of that planning if you want it. So you can go either direction primarily, right? You can either do it yourself and do that function, or your third option is you have to pay somebody. So we're saving you at least $100,000 from paying somebody to not have to do the trading, possibly not have to make the decisions on those amounts to keep in your checking account and the transfer. Obviously, if someone's working with tax hack and you can make those suggestions. So again, it could be self-serve, or you could be building an external team and an internal team around you to make those decisions on those numbers.
No, and I will share, for those listening and for those in the CFO community, we usually talk about a 13-week cash need. And then we're usually talking about what percentage of that do we want to have liquid. These things came up early in the COVID days. And as we were like looking at PPP funds and what we need in the bank account, just in case there is, for whatever reason, something like a pandemic where like no one's going to pay their invoice for 30 days. Like how much cash would you take to survive? So if I'm understanding correctly, you determine that number. If you worked with us, we'd say, hey, look at what your 13-week number is. That's pretty conservative and industry standard. And if my cash drops below that level, am I understanding this correctly? The reverse sweep automation is going to sell off some of the, I don't know if you want to call them treasury assets or whatever, but essentially we're getting some of that cash back into the operating account at that level. Am I understanding that right?
100% correct. Yeah. Typically us, like you, we recommend 13 weeks, 3 months worth of burn, 3 months of expenses, or 3 months of payroll. That's just kind of like, as you're saying, and I agree with the golden standard, right? So you kind of usually set that as your minimum desired balance to always be there. And as an example, on the top up amount or the reverse sweep, we typically will recommend like a 1 to 3 month top up or move back in, because you can't leave yourself high and dry. It's not good. Your employees aren't going to be happy. Again, the single garage founder you got to keep the lights on, right? As your company gets bigger, you have to pay your employees or you won't have any employees. Exactly like you're saying. We start with the 13-week cash, 90 days worth of cash, and then kind of build from there for the sweeps. So 1 to 3 months typically.
I think that's really important. Because you do worry about locking up funds, so for those listening, don't do what Miguel did and invest in a high yield fund that locks up your money for a full quarter and requires a 3 months notice. If you don't need that cash, then I think things like that work fine. But as I learned, I wish we had reverse sweep automation a few years ago. So take from my mistakes.
That's it. It's interesting. There's a lot of stories like that out there from, even past before the SVB days, the old 2008, there's a lot of startups got caught in those types of funds, which is very interesting.
It is not a good day when you email your financial advisor and they're like, hey, can you wire me X? And they're like, yes, next quarter. It's not a good day. I think it's a fantastic solve for that concern. We are a Rho customer. We're explicit about that. We like it when there's one good strategy. I think we really like it when there's two, and we really love it when there's three. So part of this discussion is, hey, let's stack not just the treasury, but some of the other benefits that you should be thinking about in the platform, outside the platform. One thing that we love is the 2% back on expenses. It's something that there's some requirements to get it, but it's just something that we think is a best practice, especially for us as a firm. It's not just a mom and pop business where I'm using the cash to, buy a Rivian, which I would love to do, right? Like I have fiduciary duty to maximize the cash and return on cash. And rather than, with some credit card programs where you bank the points and there's different categories. Part of the reason we moved over is 2% on all expenses, any categories. And then that cash just gets, that 2% just gets deposited into our account. So, if you're thinking about getting 3 to 4% of your cash, don't forget that, our message to clients, don't forget that if you're spending $1 million, $2 million a year, whatever that number is, 2% is pretty significant. 2% is something you can add to it. So Mike, I love what the team's doing here.
There are multiple providers out there that, do corporate credit cards and all that type of stuff. And if you're not like the points guy on the personal card side, where you're trying to figure out how to handle rotating categories and points and all this type of thing, you can start your own job doing that, right? We were like, let's make it simple, easy for people, straight 2% cash back with the idea exactly what you're saying, right? Your spend should allow you to make or have more spend. So let's make it dead simple for people. Let's give them an extra 2% back on their spend. And then they can go and re-roll that into whatever initiative they have. That could go into expenses. That could be offsetting salary. It could be for whatever it wants. So it's all about ease of use, straightforward. And then the beauty of it all, again, like everything else with the treasury and the platinum product, it's all on the platform. So it's flowing right into your wheelhouse, which is tax and accounting. It's flowing into all that. So it's super easy and again, one login, it's all built in there. So I think you've hit on most of the points. I just like to always hammer home. It's a free 2% on the money that's already going out your door. And it's kind of, again, going back to buffering the inflation, and it can be used however you want it. So again, you're not quarantined to specific categories and all that jazz.
Let's take a break here.
Before we jump back in, I want to take just a quick moment to share something with you. You might have noticed this podcast is evolving. Not in what we talk about, but how we bring it to you. Beyond the Bottom Line is being shaped specifically now for podcast listeners. Same insights, just now delivered in a more engaging, listener-first format. And we want your voice to be part of it. If you have a question that you'd like us to answer, or a topic you'd like to hear covered, or even if you want to share some feedback on the show itself, send it our way at media@centurionfirm.com. That's media@centurion, CENTURION, firm.com. We'd love to hear from you. Now, let's get back to the conversation.
So let's recap what we've talked about here so far. We've talked about two pillars of extending runway. Pillar one is getting that 2% back. So on $1 million of spend, just an example, that's about $20,000. So we've been able to bring that back into the business, extend runway a little bit. Then we talked about parking idle cash using Rho's treasury platform. That is another way, if we're looking at something like a 3.9% treasury rate, that's another way to get another 20K, assuming 500K in idle cash. So for companies that are raising money and parking it into a checking account, you're losing purchasing power because of inflation. That's what Mike's getting at. Now, we're going to talk about the third pillar. Let's dive into how we're going to use the R&D tax credit to get some cash back on things you're already doing in the business. We've talked about the treasury. We've talked about the 2% expense. We're talking meaningful dollars here, right? If you can get $1 million annual spend, I mean, look, that's 20,000. That's a bonus to retain someone or an amount to hire the right person, at least to help. We talk to our clients that are developing technology. So we're talking, hey, maybe 60K on what you're already doing. It's not coming from doing anything new other than using the Rho platform. It's coming from the cash balance you already have, the spend you already have. You're just being strategic about getting ROI on that. For those developing technology, we've also got the R&D tax credit. So, assuming a very low amount of spend, even one person full time, let's assume 100. These are supposed to be 100,000s, but if it's 600,000, we can get a $60,000 credit. If it's $1 million in spend, we start looking at 100 and 150K. Now, let's add a little bit of clarity and flavor to what we're talking about with the R&D tax credit, specifically about how to claim the credit. Tax credit is a refundable credit, meaning you can get money back on taxes you've already paid. And that way that works is that for businesses that are in their first 5 years, they can take the credit against payroll taxes. That means that every time you run payroll, if you claim the R&D tax credit, you can get a refund or a rebate on the employer portion of those credits. So oftentimes we're collecting a larger credit than we can claim each quarter, and then we claim it every quarter. So if you have a $100,000 credit and you're paying $25,000 in employer taxes every payroll run, what you're going to do is you're going to file a quarterly amendment to get that cash back. So you can get back $25,000 every quarter until you hit that $100,000 threshold. And when you stack that up, we're talking about, $2 million company in burn rate. I mean, we start seeing benefits of 150 to 250,000. There's different bases, right? Because we're talking about cash balances, we're talking about spend, we're talking about R&D, but for a company that has burn of 2 million, we're talking about very significant cash that can start to be really meaningful in extending your run rate and increasing. It's really non-dilutive capital that you can get back just from the activities you're doing. So a lot of juice to squeeze when it comes to being strategic and looking at those three strategies: treasury, getting percent back on your spend management, and then number three, with getting tax credits that are already on the table that you can pick up just by working with an advisor. And that's where we'll come in. And the way that we work with our clients is we're taking a proactive approach. I think a lot of the industry gets used to just looking at last year or last quarter. We meet with our clients on a quarterly and projected basis. We look at the balance sheet. So we're evaluating if there's an opportunity around sitting cash. We are looking at, your finance stack, how many credit cards you have, how you do your spend management. Some of these credit cards, if you guys know, when you've got multiple accounts, the accounting can be an absolute nightmare. So what we're trying to do is not just say, hey, look, let's try and make sure that we're ready for the tax bill, or that we've got a tax refund, or that we've got a tax credit strategy in place. What we're also doing is saying, hey, how can we make the finance organization better? And oftentimes it has to do with your fintech stack. So which banks you use, what you use to collect all your expenses, receipts. You need receipts for meals over $75. People roll their eyes and you feel like you're back in middle school and your teacher's telling you to dot your I's and cross your T's. But the reality is, if you do get audited and there is a review, the number one thing the IRS goes after, it's meals and entertainment. So what I love and what I'll call out, when I spend money on my Rho card, I get a text right away and I can take a picture of the receipt and it uploads into the general ledger and the technology. So those are the things that we're helping our clients with. And I think Rho, having the right partner, is not just going to make your life easier. There's also some real cash back that we want our founders in our community to be aware of. And automating, talking about treasury, what we also think about and talk about is, look, you have a tax bill coming in a year. There's some exceptions to this, but you need to pay it by X date. Well, I just want to prepay it. And that might be fine. If you want to prepay your taxes, the IRS will gladly take your money and not give you a single dime on it. Or what you can do is some kind of treasury management where you have a reserve set up that gets some yield on your cash. So those are the things that if I talk to a founder over a beer, those are the things that I want to make sure that they're at least thinking about. And that's really the purpose of this conversation. Is we've got Mike who's sharing his expertise and myself, and we're telling you, hey, you're crazy if you're not looking at this. And the beauty of the Rho platform, in our opinion, is that you can take some serious action with very simple next steps.
I think that is a fantastic example, though, that you just hit on with the prepayment or earmarking, allocating however you want to your future tax implications or your payments that are needed. Some people, I don't have to tell you, but some people would just not even think about even going down that path because they would say, oh, it's too difficult for me to try to earmark these monies. Then I got to go and find out how I'm going to put that money to work. But it's super easy once you understand which platforms you can have access to, the technology that's out there, especially when they're working with someone like you, because you can give them those numbers for the earmarking, and then they can go to the platform and invest that cash, that idle cash. So they're getting the return on it before the tax man cometh, right? So who wants to pay the tax man more money? If you can use interest rates that are set by the tax man and woman to save some of the money that they're trying to come and get from you, it's a perfect example of stacking strategies of both treasury, expense, not really exactly in that, but also the tax strategies that you provide.
And we've talked about it. Like, I think that founders are focused on their business, and rightly so, driving sales, streamlining operation, thinking about the next level. It's really difficult to think through all the things that we're talking about. And that's the point. And having a group of people that have thought about this for a long time that are going to help you take the little micro steps to maximize cash in the business, is the point. Like we hear a lot, you don't want to leave a tip when you pay your taxes. But I think the strategy that we're talking about is how can you get a tip on the tax bill that you're going to pay? And that's essentially what we're doing here, right? Because you wire out, and by the way, you could write a check right now for $10,000, write U.S. Department of Treasury, mail it, and they'll cash it. No questions asked. They're not even going to ask who you are. They might not even apply your payment, right? So there's no issue writing that check. And I think, we have clients that just wire it out really quick. I just want to be done with it. And what we try to do is like, well, let's think about this. Is there interest and penalties if you pay by the final deadline? And there's exceptions to this, but look, if you pay everything April 14th, you have a year or 8 months, depending on what your cycle is, where you've been able to get some yield on that cash. And I think too, the beauty of treasuries is that sometimes when you look at your bank balance, you think I can use this for whatever. What we try to do is we try to segment out, whether it's bank accounts or treasury strategy, to say, hold on, no, like that's allocated for tax. So we're going to remove that from the operating picture. So yeah, I think you can really integrate the strategies that we're talking about doing it that way.
100% agree. These strategies are for everybody. And people just need to actually implement them and understand them. And I'm glad that you're out there preaching the good word.
And look, I'll say, we work with accountants ourselves. So, we will handle just the tax side, or we'll handle just the R&D side. We're never going to be, a PwC. We're never going to serve everybody. So it's not even about, like, how can we help you? Like, we have this crystal ball of knowledge that you have to work with an advisor. I think, if you have an account you love, it's fair game for you to take these recommendations to them and see if they can help you execute. So, for those, it's like, my accountant always sets us up on X bank or whatever. I mean, bring the benefit to them. And I think for the large part, we love our accountant. They're like, show me the math. Like, we wouldn't be here if the math didn't math. So look, if you're a CFO or sorry, if you're working with the CFO or you're working with the accountant, I mean, bring these strategies to them. Hey, are we doing this? Hey, do you have a partner you work with for the R&D tax credit? Do you think about treasury? And I think where the market is, and the reason we're so excited is that we just want to spread the word and get the conversations going, is the market's really early in the SMB space. And to be honest, I mean, the SMB space is underserved. It's something that, again, you can take this to your current advisory team and say, hey, can we get on this? And if they're like, no, we're going to keep with our bank and we're going to stay on QuickBooks Desktop, maybe you start looking for someone a little more strategic. But I think the point is that strategy really starts with the founder. Even better if you have a team and a tech stack that's going to enable that. But if not, I mean, it's not hard to get started. Pretty sure it's easy to set up a bank account with Rho.
That is 100% correct. Could be done in one day. Could be done in a couple hours. I think the first thing I would love to make sure people understand is don't let the money just sit there and collect dust, right? Every dollar is an invisible employee, is a way to kind of think about it. That dollar should be going to work for you. There's easy strategies to implement on the treasury space to make those dollars continue to grow and work for you. So definitely just don't let it sit there. That's number one. And number two, I guess, is really think about the Pareto 80-20, right? Starting is definitely easier than you think, right? You can do 20% of an effort and you're going to get 80% of the value. So again, it goes back to you're the single or the two co-founders in the garage. Start early. It's easy to start. Get that infrastructure started now because your company's going to grow. For the companies that are maybe a little bit longer or a little bit more mature, now time or a review of what you're currently doing is also great to go back in there, review everything, and can continue to build it and become more sophisticated as well. So again, don't set and forget it for the more mature companies. You're going to want to continue to reevaluate and see how you can do better over time. That's the main takeaways for me that I hope everybody has.
I think the point on the setting and forgetting is I think sometimes in our practice, we see founders who are like, hey, we've already dealt with tax, or we've already, looked at our financials for the month. I think taking an approach where at least there's a quarterly cycle to look at how you're allocating cash, or, what's working for you from a finance perspective, what's not working from a tax perspective is really critical. If it's just you and your co-founder in a garage, or I think the modern garage is like a WeWork or an Industrious, right? But if it's just you, I mean, you can do these kinds of things where you're at least building that muscle. If you have an advisor that's also thinking about this, that's having these conversations with their clients, you're going to get the quality and benefit of the ecosystem. So they've already saw, like with us, like we had clients on SVB, like we've had to solve these, like, oh my gosh, what do we do? Kind of things. Benefit from the experience of the community here. So I would just add, again, going back to my main point, even if your advisor isn't driving these strategies, it's important, and I think it's appreciated eventually that you, as the client founder, are bringing those forward. At least that's how I think about it. When clients come to us, they've got a new tool or idea.
Yeah, that's a great way to say it. And I also think too, like when I see, what if I only have 50,000 in my account? I immediately just want to blurt out, just be curious. And it's actually what you're talking about. Like if you've only got 50,000, be curious. Go see what you can. Go talk to your peers. Go talk to your advisors. Ask them what opportunities you have and where you can actually become educated on it. You got to start the muscle memory. You got to start the structure early on, because that's going to set you up for the future. So that's what I would say. I would say be curious if you're sitting with 50,000. And I would also say congratulations. You probably wrote that check yourself and you're going on a crazy endeavor yourself, running your own business or starting your own business. So be curious, get excited, and get educated. And if you're not willing to do the legwork, or you think it's going to be too difficult, lean on your advisors like you, Miguel, and TaxHack, or whoever you're working with, right? Take your curiosity and what you find and what you educate yourself on from your peers or ChatGPT or AI overlords, then have those conversations and go to your advisors as well to get some feedback and start instituting structure early on.
So Mike, what are the best low risk options for earning yield on idle cash?
That's a great question. And there's luckily a lot of interesting options. The first step you're going to always do is see who your providers are and what they actually offer you, right? So you're going to start with what's available to you with your provider. And then from that point, you're going to have to probably do some searching as well. But typically speaking, you would start with an FDIC cash product. So like a sweep product or something like that. So every dollar for dollar is going to be invested in FDIC protection. And then you kind of graduate above there. Then you're going to start going to treasury bills or money market funds. Which one of those two is better is going to be dependent on the person you're talking to and their risk profile. Because I'm sure you've come across too, younger founders and CEOs these days, they always just want to default to a money market fund, which is great because it is a very safe product. But if you go and you look at an older founder or an older CEO, they may be around from 2008, 2009, but they're scarred like you about money market funds because there were some, money market turmoil back then. So they may default to treasury bills over a money market fund. And then your progression above that, where you start looking at corporate bonds and things of that nature. But that is for, once you start hitting, 25, 50, $100 million, you start going up the stack. So you're going to want to start with FDIC cash products. Then you're going to want to go into treasury bills that are like offered on the Rho platform. And then you may want to start considering mutual funds and money market funds that may hold some different assets. As an example, like we had talked about earlier with our mutual fund offering, you're getting 4 assets all in one button click. So, you can slowly start going up, but generally speaking, you're going to be FDIC cash, treasury bills, money market funds, and then start looking at certificates of deposit, corporate bonds, et cetera, et cetera. But most companies won't go past the treasury bills or the money market funds because again, they're focused on building their business. They're not a hedge fund. They don't need to be stretching to different asset classes, nor do they want to stretch to different asset classes to make extra, 5 or 10 basis points. So they'll stick with whatever's the most liquid, making sure that they're getting paid and making sure that it's low risk.
That was very helpful. I know our clients are looking at interest rates on the daily, and especially this past week. How do rising and falling interest rate impact cash management?
I would probably say the shortest answer would be it depends on how mature your company is. Meaning, again, going back to my example of, your single founder in the garage, or maybe it's you and another founder in the garage, you shouldn't even be worrying about rising and falling interest rates. You should be picking the easiest option that's giving you exposure to interest. So if a treasury bill or whatever, you should just be involved. Right? You just need to be involved. Going back to don't let the cash just sit there. You can do something 20% and get 80% of the value, right? So on that side, you just need to be involved. As your company matures and you have more money, then this question becomes a little bit more interesting because then you may be looking to be more advantageous or pre-plan to the changes of the interest rates. But what you'll find is when there's an interest rate change potentially coming towards the downside or falling, you're going to see, and you can even just look this up super easy on Google or whatever your preferred method is, you're going to start seeing people looking to increase their duration or increase how long their bonds or their treasury bills or their corporate bonds are. Because what they're doing,
move up the yield curve.
Correct. The yield curve. They're looking to go and start owning longer maturing assets. Because what they're effectively doing is they're wanting to lock in that rate of return for a foreseeable period of time. So they're basically saying if interest rates are at 5% today and they're going to be going lower in 6 or 12 months, well, I want to now own something at 5% that's going to be at 5% for the next 5 years. The interest rate environment going lower, you start thinking about holding things longer. It's the reverse when interest rates are rising. So if interest rates are at 1%, you want your money to continually turn over or mature, however you would like to say that, because as interest rates continue to go higher, that money becomes reavailable and gets reinvested at the higher rate. It matures, it goes higher, and gets reinvested again. So again, on the rates going lower, you're thinking about investing for longer. And when rates are going higher, you're thinking about investing shorter, because you want to keep turning your money over and over and over again. And then when there's nothing happening, which is always, goes up, down, and sideways, then at that point, you kind of just on cruise control and you wait. But one of the interesting things is most companies, largely speaking, so you get very, very large, you shouldn't be trying to game which direction interest rates are going, right? Like you should be focused, I guess that kind of goes back to your company's not a hedge fund, right? Focus on how you can get your idle cash, making more cash for yourselves in a low risk, conservative way, and be happy with that until you need to start looking to, or you have the great pride and you've done so well that you have so much money, you need to look for other opportunities.
No, that's great. I suppose we should say, because I think someone might be wondering, like, okay, when interest rates go down, yield is going to go down as well, right? So just have that basic corollary. How do I think about what I should have in my operating account versus my treasury account?
I think I already kind of touched on it, so I actually would love to hear your answer.
Well, I usually work with minimums with our clients because we got clients who are like, yeah, like I get the idea, I get the sophisticated answer, but like, how much do I really, need in my operating account? And I'm going to go with the accounting answer, which it depends. I mean, I think like it depends on sales cycle for sure. So a client that, is in B2B that has, that gets paid upfront at the beginning of January is going to have a different changing number throughout the year. So, you might need very little operating cash in the beginning. This is how it gets complicated. And you could park a lot in treasury. So that split can be 90-10 if you have something like that. If you're like some of our other businesses, which bill their clients on the first of the month, then you're gonna have basically a target number to hit by the 15th, where you are going to at least want to have a safe amount of cash. And then what I'll say for our small businesses that, are revenue funded even, I'm sure there's folks on here who are like, hey, I didn't raise any money, but I've got a good amount of cash in my bank just from, we're profitable and pay some taxes. Those are situations where you can be a little more aggressive and you can have a lower floor in the operating account. And we say, minimum for safety, we can talk about it, is going to be 2 payrolls, 1.5 payrolls if you really want to get to the minimum. But I just know some of my founders and clients that we work with, they're like, I want to really go hard on the treasury. But the nice thing is you can, adjust it. And with something like reverse automation sweep, you can make sure you never go below that. Because if you're really operating on that 1.5 times payroll, again, it assumes that most of the businesses costs are payroll. So that works for some businesses, not all. E-commerce business is going to be a lot different because we're looking at when you purchase. So those are kind of, what are the cash needs? When does cash hit? What's AR, percentage likely? So it can get pretty complicated, but generally, I think we want to establish a minimum where you're not going to, have a cash crunch and you have cash parked somewhere else.
You took the words out of my mouth, which was fantastic, because I think we are definitely thinking alike. And obviously, the reverse sweep kind of solves a lot of those problems. So the depends answer really has like a fail safe with the reverse. But I think it also really just comes down to the company's level of comfort and risk, which, it's difficult for you and I to try to manage those expectations, because there are a lot of founders and CEOs out there that do love to optimize for yield. And sometimes they will, as we talked about a little bit earlier, they will put themselves in a little bit of a bind sometimes, but never good. So I'm always one to err on the side of more conservative, but that's how it goes.
Now, what's the difference between like a CD and treasury management? And I think it's a component, but I think that's a question for you.
That's a great question. I mean, all a bank CD or a certificate of deposit it's just a tool. I consider treasury bills, mutual funds, bank CDs, choose them. They're all commoditized and they're just tools of treasury, right? The treasury and the treasury strategy is what you're actually doing. How you accomplish that strategy is the tools that you're using. So again, a treasury bill is a tool, FDIC sweep fund is a tool, a bank certificate of deposit is a tool. So they're just tools. They're all commodities, basically no name on them, right? But they do have certain features. So you do need to explore the features. One of the things, a lot of people, I literally just had a conversation with a founder yesterday or the day before, raised $19 million. High five, congrats. He's thinking about putting it all into a certificate of deposit. I said, that is very interesting. Why would you do that? He knows about those because of his personal finances and investing. I said, that is 100% valid and good. But then you go another level deeper. And I said, have you looked into, and this is like a tidbit that some people should be thinking about if they're using or thinking about certificates of deposit, make sure you understand the language of the contract, because most CDs, if you need to get that money out, you give up every cent of interest you have earned. And depending on some of them, which are very rare now, you may actually lose a little bit of money because of the actual CD structure, depending on the bank or, however it works. So if you're looking at CDs, they're a great option. You just need to be knowing that you should be holding them for the full maturity or duration of that CD, or you need to actually really get into the terms of service and agreement to know that if you do need to get your money back, what that ramification to you is going to be.
Yeah. Assume that you're not going to be able to touch the cash for whatever that period is.
100% correct. You need, when you send that money for that CD, you need to mentally be thinking that it's probably gone for that whole time period, unless you're willing to just be happy with getting your money back, which kind of defeats the purpose of using that.
Defeats the purpose, yeah. Because you got 0%,
Correct. And what part, it's actually worse than that, because if we think about it, going back to inflation, if it's a 1-year CD and then after 9 months, you've accumulated all this interest and you need to get your money out and they're going to claw that interest back, you actually lost more than that, because you just wasted 9 months of interest accrued that's been taken away. You lost the interest and you watch your buying power go away from inflation. So food for thought.
So there it is. So CDs is a component. It is not the treasury strategy that we're talking about here. Well, this has been fantastic. I appreciate the time. I know I've learned a lot. I'm sure others here are taking good notes and are going to take some action. Again, thank you. It's been such a pleasure to have you on, Mike. Wealth of experience. And I know I got stuff that's actually going to save or make me some money. So that's what it comes down to.
Well, thank you for that. I've had a lot of fun too. Tax Hack and you all are great partners of ours, providing tons of value as well. I'm more than happy to obviously speak with people as well once they talk to Dom or reach out to me directly, however people want to do it. And we can carry on the conversation around treasury strategy, et cetera.
Thank you for joining this conversation with Michael Dombrowski. To make this conversation more actionable, I encourage you to write down 1 or 2 things that you took away. And if you want to connect with me, you can connect with me on LinkedIn, where I'm fairly active. Look for Miguel Alexander Centeno. If you found value in this conversation, make sure to subscribe on whatever platform you listen to podcasts on. Stick around for the next conversation, which you'll learn might change your business.